welcome to ED Insight, where we get you a 360-degree view of the big picture in business and economy. I'm Sridharan Ramakrishnan, and here's what we have for you on the show today. The turmoil in America and Europe is bad news for the world economy, but Asia remains relatively insulated. So what are the best and worst case scenarios for India? With the US and Europe staring into years of slowdown ahead, global fund managers may have little choice but to put money in India. But don't take that for a given. And what India needs to do to ensure that it remains the shining star of the East. Our top story first. When America sneezes, the world catches a cold. And a downgrade in its sovereign rating, the first since 1917, has sent global markets into a tailspin. But the worst is not over. Apart from the US, the Eurozone is in turmoil. The only silver lining is the robust growth in emerging markets such as China and India. But can India remain unaffected if its key markets are suffering? After the Lehman crisis in 2008, India's growth slowed from 9% to 6%. What should you expect this time around? Asha Gopalakrishnan finds out.
The beginning of a long, dark night for the world's largest economy heralds the dawn of a new era for emerging markets like India. But it's not going to be bright and sunny all through. Dark clouds from the west will weigh down investor sentiment, and a weakening American economy will consume less of everything, including what India exports. But this is not the first time that a problem of this magnitude has hit the global economy in the recent past. And if the past experience is anything to go by, then markets like India may weather the storm.
Our markets have the capacity to withstand the negative sentiments affecting the external world. We have taken several measures to make our markets attractive, robust and vibrant, and would continue to do so, making it an attractive investment destination for foreign capital. As global investors look for opportunities across the world, India's attraction as an investment destination would continue to grow.
Standard & Poor's, the agency which downgraded America's credit rating, somewhat agrees with that. In a statement, S&P states that there is no immediate impact on Asia-Pacific sovereign ratings of the American downgrade. The rating agency explained that this generally stable outlook for Asia-Pacific countries comes on the back of sound domestic demand, relatively healthy corporate and household sectors, plentiful external liquidity and high domestic savings rates.
The global events is a matter of concern, but not a matter of alarm, because the long-run story remains more or less intact. So let me explain one very important thing. That the United States economy has been having difficulty in getting back to its higher growth path, we've known now over the last several months. So to that extent, a large part of the story is already priced into the stock market.
That's good news. The bad news is that S&P has also stated that the US rating change, combined with the worsening balance sheets of countries in the Eurozone, does point to an increasingly uncertain and challenging environment ahead. It says that, like in the recent past, an unexpectedly sharp disruption in the financial markets of developed world could lead their economies into deep contractions again, or further delay the recoveries. That would hit export-dependent economies like Thailand, Taiwan, Korea, Malaysia, the Philippines, Japan, Australia and New Zealand. That's not all. Countries that have weaker external positions like Pakistan, Sri Lanka, Fiji, Australia, New Zealand, Korea and Indonesia may face reduced liquidity and a heightening sense of refinancing risk in the near term. S&P is of the view that the adverse impact on Asia-Pacific may require governments to use their balance sheets to support their economies once again. And countries like Japan, India, Malaysia, Taiwan and New Zealand, where fiscal capacities have shrunk relative to the pre-2008 levels, may see a deeper and more prolonged impact than the last one. In other words, while Asia may be relatively unaffected by the coming American and European recession, it may not fare as well this time around as it did in 2009.
If the double-dip recession takes place, obviously it will be much worse. Now, how bad as compared to the Great Depression of the late 20s and early 30s, or how bad compared to 2008, September, October 2008. I'm not in a position to say that, but it will obviously be much worse than if there was no double dip.
For the moment, the Indian Central Bank's concern is not an economy that's stalling, but one that's overheating. Inflation, particularly in food, continues to be way above the RBI's comfort level of 5%. So, far from stimulating the economy, India is actually trying to cool off growth a bit. With crude prices falling, inflation may come down a bit on its own. And that means the RBI may sooner than later actually pause on its relentless rate hikes and in effect stimulate growth. But not everyone thinks that inflation and currency appreciation are necessarily an evil. According to a Citigroup report, investors come to Asia for growth and inflation provides top-line growth. The report states that overseas investors do not suffer forex losses on account of undervalued exchange rates. And so, one gets the benefits of inflation, that is higher growth, without the negative of currency devaluation. And if, as expected, the rate hike cycle in India is winding down, it should reassure investors even more.
It's better to be in a market where monetary tightening is almost at an end, which is in the emerging markets, rather than in a market like the United States where monetary tightening is about to start, perhaps next year, and they'll then have to see their corporate earnings starting to slide from next year onwards.
The flip side, though, is that exports will be hit in a big way. Asia accounts for more than 50% of America's imports of $225 billion. Last year, a tenth of India's total exports were to the US. The EU accounted for another 18%. If exports in India are hit, it directly affects the SME sector, which is dependent on exports for nearly 40% of its annual business.
Our new export basket, manufacturing goods, engineering goods, pharmaceuticals, chemical goods, they're far more sensitive to changes in global demand. And so we do expect to see that the sizzling export growth you've seen will moderate in the coming months.
Typically, a global slowdown means that capital becomes scarce and trade falls, which in turn leads to a fall in corporate earnings, cut in wages and employment, and a fall in consumer spending. That takes a heavy toll on the economy. But to understand the impact on the overall economy, it is important to look at its big components, which are services, manufacturing and agriculture. Based on the experience, the services sector, which accounts for more than half of India's GDP, will be the worst affected. Particularly verticals like IT and ITES, banking and finance and real estate. The IT sector is directly dependent on global markets, with nearly 50% of its revenues coming from the US and the EU.
My sense is that you will start seeing a slowdown starting this month and carrying through from September onwards. As I said, it was not going to be an easy summer. It's not been an easy summer.
As global spending on Indian IT slows down, it will reduce the number of outsourcing contracts, lead to a pressure on margins, and companies will be forced to restructure and cut costs, the largest of which is wages. But IT sector job cuts are not an ordinary issue. This sector has the largest number of white-collar workers and drives consumer spending in a big way. Ditto with financial services. The sector comes under pressure because risk appetite falls dramatically and risk aversion is the order of the day. Financial institutions see sales and revenues fall substantially as liquidity dries up. Margins come under severe pressure, and in order to cut costs, companies freeze expansions, cut jobs and slash pay scales. From services to agriculture. A global slowdown is typically characterized by falling commodity prices, which means lower income for the farm sector. At such a time, government doles out more subsidies to maintain prices, and that works against demand. Here, India is at an advantage because even the last time round, the agriculture sector was not really hit by the slowdown in a big way. That's not to say India is in clover. The manufacturing sector has already started seeing a slowdown.
We must admit that we are pushing far, far below our potential. The economic thrust given by the earlier rounds of economic and regulatory reforms need to be bolstered now by a fresh round of impetus. This is the time, this is the moment. We cannot be complacent, especially when the world around us is so turbulent and so uncertain.
An uncertain future will spur more savings and less consumption of everything from automobiles to consumer electronics to high-priced apartments. In other words, a broad-based slowdown. Some of the global brokerages are already cutting back on their growth forecasts. Morgan Stanley, for instance, has revised its GDP estimate for financial year 2012 from 7.7% to 7.2% and financial year 2013 growth estimate from 8.5% to 8%. It says that persistently high inflation, a higher cost of capital, a cut in fiscal spending to GDP, the weak global capital markets environment and a slow pace of investment will cause a further slowdown in growth.
It depends upon what happens in the developed world. If you do see recession back again in US and Europe, there will be some further downside risk to that growth forecast.
Goldman Sachs too has reduced India's financial year 2012 GDP growth forecast to 7.3% from 7.5% due to similar reasons. But it has kept its financial year 2013 GDP forecast unchanged at 7.8%. Despite this, India remains one of the fastest growing Asian economies. That's because growth here has been led by domestic demand from the private sector, a booming middle class and the government. And if India wants to continue being a rising star, it needs to get its act together sooner than later.
Apart from that, India needs to ensure that foreign investment flows remain robust. But the fear of FIIs rushing out is overstated. We'll tell you why after the short break. Don't go away.